Today, markets calm before the storm as the AI wave wanes. Hello again, it's Martin North from Digital Finance Analytics World Latest Post covering finance and problem news. This is our weekly market update where I look at all that's been going on around the world in the markets, starting in the US, going across to Europe, Asia, and ending in Australia. It's the best way I've found to organise my own thoughts about the week. And this week, punctuated by a Wednesday US holiday, saw markets taking a breather following recent volatility and record highs. In fact, the Nasdaq hit record highs on Thursday, boosted by strong gains in tech and indications of a gradual easing in the labour market and inflation levels. But on Friday in New York, the S&P 500 closed modestly lower, thanks to the quarterly expiration of about $5.5 trillion worth of options during the quarterly triple witching, in which derivatives contracts tied to equities, index options and futures mature. In fact, around 18 billion shares changed hands on US exchanges, which is 55% above the 3-month average volume. And the options expiration coincided with the index rebalancing as well. So all up, the S&P 500 closed 0.16% lower to 5,464. The Dow was up 0.04% to 39,150. And the Nasdaq was down 0.16% to 17,693. Nvidia slid 3.5% on Thursday and briefly tumbled more than 4% on Friday. At the close, it was 3.22% lower on Friday to 126.57. Its market valuation was at $3.11 trillion US. In a tussle with Microsoft, the chipmaker slipped out of its short-lived position as the world's most valuable company. It wasn't just Nvidia that was lower. Apple flipped from modest positive growth, down 1%. In the final minutes of the session, the move was linked to the rebalancing of Apple and Nvidia within the $80 billion US XLK exchange-traded fund. Now, it's worth remembering that the S&P 500 is up 14.6% this year, but most of the broader index gains have been concentrated in the information technology and communication sectors, up 28.82% and 24.3% respectively. The rest of the market has been more subdued. The next best performing sector, utilities, was only up 9.5% year to date, and more than 7% of stocks are down for the year. So the huge price gains, including Nvidia's 155% year-to-date run, has stirred worries that the tech rally might be overheated. Or look at it another way. About 60% of the S&P 500's total return for the year has been driven by just 5 companies whose shares have some of the heaviest weightings in the index: Nvidia, Microsoft, Meta Platforms, Alphabet, and Amazon. So tech appears perhaps overextended based on several barometers. The relative strength indicator for the Mag 6 index, which measures the speed and magnitude of price change in the stock market's big 6 stocks, is at the highest it's ever been. And the price ratio between the Nasdaq 100 and the S&P 500 equal weight index, which is a proxy for the average stock, has jumped 9% since the beginning of June. The S&P 500, by contrast, is up nearly 4% this month. Now, of course, tech could rebound fairly quickly as investors rush to buy the dip. So it's worth remembering the Nasdaq took 5 weeks to reach a new high after falling as much as 9% back in April. But it could be different this time, and if so, maybe the tech stocks will slide and take the whole market down with it. Economic data was mixed again, by the way, with US consumers' resilience to prolonged elevated borrowing costs showing some signs of wilting. But barring a deep downturn in the labour market, soaring household wealth should ensure it doesn't crack. Federal Reserve figures show that US households' net worth leaped by $5 trillion in the first quarter to a record $161 trillion, mostly on the back of rising equity prices, while household debt as a share of GDP fell to its lowest for 23 years. This suggests wealth effects remain positive and the economy will continue to enjoy and be driven by consumer fueled growth. If a soft landing is to be achieved, it will be in no small part thanks to the indefatigable consumer. In a deep dive analysis last month of US consumer wealth, BNP Paribas said that higher stock and house prices will lift consumer spending by $246 billion this year, providing a sizable boost to the economy. That would be the third largest boost to US consumer demand in 25 years, they reckon, and add roughly 1 percentage point to GDP growth for the year. Of the $5.12 trillion increase in total wealth in the first quarter, corporate equity accounted for $3.83 trillion and real estate for $907 billion. Now, real estate might be a little surprising given that median house prices fell 0.6% in the period, but the equity-driven component is not at the aggregate level. A rising Wall Street tide lifts all household boats. But the distribution of that ownership is very uneven, with the richest 1% of the country owning 50% of equity wealth and the top 10% holding around 90%. But in aggregate, consumption still grows as the richest households account for the lion's share of retail sales in dollar terms. If you zoom out further, household net wealth has risen by around $40 trillion since the pandemic, Fed data shows. Even adjusting for inflation, that is still up a staggering $19 trillion, according to analysis by Barclays. On the other side of the balance sheet, meanwhile, household debt as a share of GDP slipped to a 23-year low of 71.1% in the January to March period, from 71.3% in the fourth quarter last year. Households' share of total US debt in the first quarter stood at 27%. The last time it was lower was back in 1956. So in short, it seems consumers and Wall Street have so far withstood the Fed's most aggressive rate rising campaign in 40 years that has ended up with the highest interest rates in many years. But note, though, that US investors shed equity funds for a second successive week in the 7 days to June the 19th, exercising caution as they evaluated the Federal Reserve's hawkish signals and ongoing political risks in Europe. They offloaded US equity funds of a net $8.37 billion, following the $21.54 billion worth of weekly net selling in the previous week. And last week, the US Federal Reserve did keep interest rates steady, but scaled back its projected rate cuts for the year from 3 to 1, adopting a more hawkish stance than anticipated. And bonds remained well below recent higher yields, with the 2-year at 4.734 and the 10-year at 4.258. The spreads between US investment-grade corporate bond yields and US Treasuries have surged, though, to their highest in over 3 months, in a sign of risk aversion due to political uncertainty in France and as US government bonds rallied. Spreads indicate the premium investors demand to hold corporate bonds rather than the safer government securities. The moves followed turmoil in French financial markets, where, ahead of France's surprise parliamentary elections, investors sold government bonds because of concerns over a budget crisis in the Eurozone's second biggest economy. Barclays strategists said in a note on Friday that the sell-off in US corporate debt was partly due to a flight to quality caused by political uncertainty, with investors moving to safer US Treasuries, which also rallied this month after better-than-expected inflation data. Still, credit spreads remain historically tight due to US economic resilience, despite high borrowing costs and the prospect of lower interest rates going forward. This time last year, investment-grade spreads stood at 135 basis points. And the DXY was last at 105.83, highlighting the stronger dollar, as the US economy still looks like the best dirty shirt. Oil prices settled low on Friday, pressurized by that stronger dollar. As oil is priced in dollars, a stronger greenback makes oil more expensive for foreign buyers, weighing on demand, but still bagged a second straight weekly win amid signs of improving demand in the US, the world's biggest oil consumer. The US crude futures traded 0.86% lower to settle at $80.59 a barrel on Friday, and the Brent contract fell 0.81% to $85.06 a barrel, but sentiment on demand remains on the up and up amid recent data showing decline in weekly US crude and gasoline inventories, and the number of oil rigs operating in the US fell by 3 to 485. And Ukraine's military said its drones struck 4 oil refineries, radar stations, and other military objects in Russia in the early hours of Friday. Elsewhere, the gold futures contract was weaker, down 1.45% to 2,334.75 on the stronger US dollar. Now, over in London, stocks there closed the week on a positive note after domestic inflation fell to the Bank of England's 2% target earlier in the week, raising bets of an interest rate cut in August, but a hot reading of the retail sales tempered some of that optimism later. The Bank of England accompanying statement was finely balanced, more dovish than expected, and revived the expectation that the Bank of England would announce a rate cut as early as August. And because the market was pricing a rate cut not before November, before the meeting, the decision sent cable to 1.2654. But there is one more hurdle to an August cut, and it's the Bank of England's new member, Claire Lombardelli, who could be perhaps more hawkish and may prevent the dovish camp from reaching the 5 voters needed to secure a cut. Right now, we're at 2. So the FTSE was down 0.42% on the day, while it logged a 1% advance for the week and snapped a 5-week losing streak. British retail sales rose by 2.9% in May, rebounding sharply from a revised 1.8% decline in April. And economists polled had forecast sales volumes would increase by just 1.5%. And meanwhile, British businesses are expanding at the slowest pace since the economy was in recession last year, as some companies put big decisions on hold until after July the 4th's election. The Swiss National Bank cut its rate by another 25 basis points this week. The latest uptick in inflation didn't bother the Swiss policymakers, who consider that inflation remains in check in Switzerland. They prefer to give the economy, especially the Swiss exporter and families with mortgages, the additional support they needed. German government bond yields fell on Friday after economic survey data from the Eurozone came in weaker than expected, supporting expectations for policy rate cuts. Euro area business growth deaccelerated sharply in the month as demand fell for the first time since February, according to the survey-based data. Weak demand dragged down France's business activity as the country heads into a snap parliamentary election, while an upturn in Germany slowed in June. German 10-year bond yields, the benchmark for the euro area, fell to 2.37%. But French 10-year yields fell in morning trading before reversing course later in the day to trade roughly flat at 3.163. The gap between the French and German 10-year yields, a gauge of risk premium investors demand to hold French government bonds, widened 3 basis points to 75 basis points, having gapped to around 80 basis points last Friday. That's the widest level since February 2017. Money markets have priced in around 70 basis points of cumulative European Central Bank rate cuts by the end of the year, from 65 basis points before that PMI data came out, implying a further move and a 70% chance of a third cut in 2024. France's far-right National Rally Party is seen leading the first round of the country's parliamentary election with 35% of the votes. According to a survey released on Thursday, President Emmanuel Macron's centralist camp was in third place with 20% of the votes. And the DAX ended the week down 0.23% on Friday, and the CAC 40 down 0.56%. Now, over in Japan, the Nikkei 225 was down just a little on Friday at 38,621, while the Topex followed suit as the yen-US dollar was touching intervention territory again at 159.82. In China, the CSI 300 was down 0.22% to 3,503, and the Shanghai Composite was down 0.24% to 3,003. The Shanghai benchmark stock index rose 20% since February to mid-May, but is down 6% since then. A sliding yuan and extensive outflows of cash from the mainland into Hong Kong shows that China's domestic investors are shelving expectations for any immediate recovery in their home markets and fleeing to the closest, better yielding assets. The yuan has dropped to a 7-month low this week, alongside a reversal in equity investment flows into China. It was last at 7.2610 against the US dollar. The yuan is about 2.2% down against the dollar so far this year. The PBOC's daily guidance for the yuan, which it manages pretty tightly is stirring speculation that authorities are actually allowing some depreciation to manage the pressure. Analysts said Hong Kong's stockpile of yuan deposits have also grown as mainland investors use their limited offshore investment channels to seek higher yields, and companies prepared to pay annual dividends, adding to the pressure on the currency. Perhaps investor patience has worn thin after months of waiting for authorities to roll out more stimulus, mainly to support a sinking property sector. Foreigners who had returned to the market since February after quitting in 2023 have turned sellers too this month. Analysts say investors have several reasons to pause and reflect, not just how far the People's Bank of China will ease rates, but also on the approaching the July plenum of China's Communist Party to shake economic and fiscal policy. And as mainland cash floods into Hong Kong, yuan deposits in the financial hub are at record levels, with the latest official data for April showing that they stand at 1.09 trillion yuan, close to peaks last seen in January 2022. The Hang Seng was down 1.53% on Friday to 18,053. Analysts think that the Hong Kong market could benefit once the Fed starts cutting rates. And the US Treasury on Thursday said that no major trading partner appeared to have manipulated its currency last year, but it added Japan to a foreign exchange monitoring list alongside China, Vietnam, Taiwan, Malaysia, Singapore, and Germany, which were on the previous list. Countries are automatically added to the list if they meet 2 of 3 criteria: a trade surplus with the US of at least $15 billion, a global account surplus above 3% of GDP, and persistent one-way net foreign exchange purchases of at least 2% of GDP over 12 months. Now in Australia, Australian shares rose on Friday to finish the week 0.9% higher as gains among energy, healthcare and technology stocks offset falls in the miners. On the day, the ASX 200 finished up 0.3% to 7,796 for the second session of gains in the week, in which the Reserve Bank held interest rates after cautioning that it had not ruled out further interest rate increases. Mining stocks were the worst hit over the 5 days of trading, ending more than 1% lower, while utilities and banking stocks were the best performing of the ASX 11 sectors. The materials sector lost 0.1% on Friday and has tumbled 9.5% over the past month. The worst performing stock on Friday was iron ore and lithium giant Mineral Resources. It tumbled 7% to $55.76 and is now down over 30% since late May on weaker iron ore and lithium prices. Other lithium stocks were also among the worst performing. Liontown Resources fell 5.1% to 93.5 cents and IGO dropped 4.8% to $5.58. Shares in Helena Group, formerly known as Genworth, were the best performing on the local benchmark on Friday, rallying 5.2% to $4.08. The gains came after the stock plummeted around 20% earlier in the week after revealing a key contract with Commonwealth Bank was up for tender. And early in trading, Commonwealth Bank reset a record high above $128 before paring some gains back to close largely unchanged at $127.68. It was within striking distance of dethroning BHP as the largest stock on the ASX more than 2 years since the end of the iron ore giant's London listing made it the country's most valuable company. The bank closed Friday's session with a market capitalisation of around $214 billion, compared with about $216 billion for BHP, the index's largest stock. BHP's shares have sunk more than 15% this year and slipped a further 0.7% this week, weighed down by falls in the price of copper and iron ore. If Australia's largest bank can close the remaining distance between the two companies, it will mark the first time CBA has overtaken BHP since November 2021. But the rallying in bank stocks, which began late last year amid signs of a softer than expected economic landing and impending rate cuts from global central banks, have defied most analyst expectations. In fact, no analysts covering CBA hold a buy rating on the stock, while more than 80% of analysts are advising holders to sell at a record high price. That compared with about 35% of analysts holding a buy rating or equivalent for BHP. UBS analyst John Story estimates the fair value on Australia's major banks, which also includes National Australia Bank, ANZ and Westpac, could be about 20% lower than their current share prices. Overall, clients think the impending tax cuts will provide further relief to consumers, while low unemployment numbers and rising property prices means the credit cycle is turning out to be far more benign than initially feared, he said. That said, CBA's record high share price has also drawn the attention of short sellers, with Regal Partners Chief Investment Officer Phil King revealing this week that he was betting on the stock to fall. That sentiment was echoed by clients surveyed by UBS. Some clients are putting forward the case that the Australian market is inefficient in terms of how they price bank stocks, as a large retail investor base appears to be distorting price discovery, while technical factors around index weighting are adding to the price squeeze, they said. And finally, in crypto, as Bitcoin sits around 64,500 US, banking giant Standard Chartered might be on the verge of launching a dedicated trading desk for Bitcoin and Ethereum to position Standard Chartered as one of the pioneering global banks to embrace spot cryptocurrency trading. Slated to be managed from London, the crypto trading desk will mark a significant pivot toward digital assets for Standard Chartered, a bank with a storied history in traditional finance. The move potentially shows the bank's recognition of the growing importance of cryptocurrencies on the global financial landscape. And talking about that, Australia's largest equities exchange listed its first spot Bitcoin exchange-traded fund on Thursday, as global demand for an easy way to invest in cryptocurrencies grows. The Van Eyck Bitcoin ETF began trading on the Australian Securities Exchange, the ASX, which accounts for 90% of the country's equity market this past week. But standing back, it's true, I think, to say that the next 2 or 3 months will be the most interesting of the year. Markets go sideways and then fall in September and October. So the question is, will that happen again this year? Bearing in mind that the AI boom could be on the turn. On the other hand, there is still huge interest in the potential of AI and a belief that AI could in fact drive the development of AI, as it were, in a recursive manner, providing perhaps more growth and more opportunity than normal. The risks are higher, the level of uncertainty is higher, and markets are, I think, probably set for a fall, but we'll have to watch and wait. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.